Welcome to part 3 of the Smart Money Concepts course based on the Wyckoff methodology. In this part, we are going to talk about market phases and structures. This builds up on the knowledge found in parts 1 and 2 of the course, so make sure you watch those before watching this one. We begin now with the study of market phases according to the Wyckoff methodology. The 7 logical events outlined by the Wyckoff method form 5 different market phases. The identification of these phases has the main goal of providing context for the trader. In other words, the trader who uses the Wyckoff method knows what to expect in each of the different phases, which is of great use because it narrows down the possibilities and makes the analysis more objective to a certain degree. There are 5 phases labeled from A to E in the Wyckoff method. Phase A represents the stop of the previous trend. Phase B represents the construction of the cause. Phase C represents the test. Phase D represents the trend inside the range. And Phase E represents the trend outside the range, or the effect, so to speak. The Wyckoff phase analysis is based on the premise that, generally speaking, the market reverses through a slow pattern, meaning that the smart money needs some time to observe orders and effectively create a path of least resistance to the opposite side. Beyond that, the slow pattern outlined by the method provides repeatable patterns that, if correctly identified in real time, can provide an edge to the trader. Let's now explore each of the 5 market phases more carefully. We'll begin with Phase A, which represents the stop of the previous trend. Phase A is composed by the first 4 logical events: the preliminary stop, the climax, the reaction, and the secondary test. In a general sense, Phase A will provide the signs that the market is transitioning from a trend to a ranging market. The preliminary stop will provide a first indication that the smart money has entered on the opposite side of the trend. The climax will create one of the boundaries of the range. The reaction will provide further indication that there is greater interest to the counter-trend direction in the opposite boundary of the range. And the secondary test will finish Phase A. The trader is not supposed to look for trade opportunities in Phase A. The trader must observe the 4 logical events from a distance and understand that they might lead to trade opportunities in the near future. Phase A is useful for taking profits from the prior trend, assuming the trader had a position. The reason for this is logical. If Phase A means that the market is transitioning from trending mode to ranging mode, it makes sense to lock in the profits from the trending mode, especially because the market might reverse and start to eat the profits that have been made already. One challenge here is that the trader will not be able to tell if the market is in fact in Phase A until the secondary test. There are 3 quick signs a trader should pay attention to in order to avoid the problem of incorrectly identifying Phase A. Number 1. Look for a climatic volume either in the preliminary stop or the climax. That is an indication that the smart money is in fact starting a campaign to reverse the market. Number 2. Pay attention to the reaction event. The reaction will provide further confirmation about the subtle signs of counter-trend volume found in the preliminary stop and climax. The reaction move tends to look qualitatively different than the previous counter-trend moves. Number 3. What ultimately confirms Phase A is Phase B. So the trader must wait for the development of Phase B before looking for trade opportunities, even when the first 4 logical events appear to provide clear trade setups. For example, it might be tempting to look for a trade after the end of the reaction, aiming for the secondary test at the climax. Even though that's possible, it's not what the methodology proposes. Just for the sake of illustration, Phase A in an accumulation process looks like this: a preliminary support, followed by the selling climax, then an automatic rally, and finally a secondary test. In a distribution process, Phase A starts with the preliminary supply, followed by the buying climax, then an automatic reaction, and finally a secondary test. Phase B can be a challenge because it is composed by successive secondary tests at both limits of the range. That's a challenge because these secondary tests might easily be mistaken by a breakout of the range, so it's key to pay attention to effort and results at the upper and lower limits of the accumulation or distribution processes. The key factor to pay attention to in Phase B is time. In ideal scenarios, phase B should be longer than phase A in terms of time. The shorter the time duration of phase B, the more we approach the fast reversal patterns. By waiting for phase B to have a longer time duration than phase A, the trader will usually avoid entering the market too soon. When phase B becomes longer than A, the trader can also increase his level of alertness while looking for a false breakout. In other words, two keys in phase B are the careful analysis of volume and price at the limits of the range and the time duration of the phase, which should be greater than phase A. That's a guideline, however, not a rule. In this illustration, we can see the textbook version of phase B in an accumulation structure. Recall that in an accumulation, the upper minor false breakout in the form of a secondary test is called upthrust action, and the lower minor false breakout is called secondary test as a sign of weakness. Phase B ends just before the spring in an accumulation. In this other illustration, we can see the textbook version of phase B in a distribution structure. Recall that in a distribution, the upper minor false breakout in the form of a secondary test is simply called upthrust, and the lower minor false breakout in the form of a secondary test is called minor sign of weakness. Phase B will end just before the upthrust after distribution in the distribution. Phase C is known as the test, and it is composed by the false breakout event, which is perhaps the most important of all logical events, and the ultimate point of the smart money manipulation maneuver. This is where the smart money will attempt to induce uninformed traders to one side of the market with the sole purpose of generating liquidity to the opposite side. This is also a way that large traders have to test if the interest in the prior trend direction has faded. If the interest in the prior trend direction doesn't fade enough, the smart money campaign will fail, and the movement after the range will be a reaccumulation or a redistribution. If the interest in the prior trend direction does fade, the smart money campaign will be successful, and the market will reverse direction. This is mainly why phase C is denominated as the test. In an accumulation structure, phase C will simply be the spring, as you can see in this illustration. In a distribution structure, phase C will simply be the upthrust after distribution, which is the mirror image of the spring. Phase D is composed by the last two logical events, which are the breakout and the confirmation. There are mainly three possibilities in this phase. Price can create a clear breakout in confirmation, which is what traders will expect. Price can meander after the breakout with some hesitation to confirm and produce the new trend, or price can create another false breakout and restart phase D. Once again, all of these things cannot be really anticipated. We have to look for the signs of volume and price, or effort and result using Wyckoff terminology, in order to assess what is really going on. In an accumulation structure, phase D will be composed by the jump across the creek, followed by the last point of support event, as you can see in this illustration. In a distribution, phase D will be composed by the fall through the ice, followed by the last point of supply event, as you can see in this other illustration. In phase E, price will be in fact trending outside the range. This phase will be composed by the impulse and corrective movements where the harmonic relationship between price and volume is expected. Phase E will provide opportunities to enter the market in the direction of the main trend as long as we don't see signs that the trend might be losing its strength, like the appearance of a preliminary stop, for example. In an accumulation, phase E will be marked by impulse movements labeled as sign of strength and corrective movements labeled as last point of support, as you can see in this illustration. In a distribution, phase E will be marked by impulse movements labeled as sign of weakness and corrective movements labeled as last point of supply, as you can see in this other illustration. It's important that you have the 7 logical events and the corresponding market phases clear in your mind before moving on to the study of structures. You should be able to tell what each of the logical events represent and which phase they belong to, otherwise the study of structures will become very confusing. The study of market structures begins with a warning. Even though we can study the theory of how structures should develop, in real markets, these structures never occur in the same way twice. The key takeaway here is to analyze these things with some flexibility in mind. We'll begin this study by looking at horizontal structures, both in accumulation and distribution processes. Let's start with the accumulation process first. Beyond the 7 logical events and its corresponding phases, there are 2 important things to pay attention to. One is the creek, which is the high produced by the automatic rally after the selling climax. This is important because it's the level we want to see price break out of. The expression jump across the creek is precisely that. The other thing to pay attention to is the presence of changes of character, meaning moments where the market transitions from trending to ranging or vice versa. The first change of character occurs in phase A, when the market goes from a downtrend to a sideways market, and the second change of character occurs in phases C and D, when the market goes from a sideways move into an uptrend. Let's quickly review the events and phases of an accumulation structure. Phase A will be composed by the preliminary support, the first attempt of the smart money to absorb supply, the selling climax, which is the climatic selling volume that ends the downtrend, the automatic rally, which is an upward price movement that is qualitatively different than the previous counter-trend moves, and shows a new interest to the opposite direction of the current trend, and the secondary test, which will test the degree of supply at the same price level of the selling climax. The secondary test closes phase A and opens phase B. Recall that phase A establishes the first change of character. Phase B is the construction of the cause, the sideways movement that precedes the new trend or the effect, as the Wyckoff method calls it. In the case of an accumulation, we have the upthrust action, which is the test of the upper limit of the range established by the peak of the automatic rally, and the secondary test as a sign of weakness, which is the test of the lower limit of the range established by the trough of the selling climax. In the case of an accumulation, phase C will begin with the spring. This is the false bearish breakout or bear trap that violates the lows produced in phase A and B. When the spring produces a violent movement to the downside, it is called a terminal shakeout. Phase C, which is composed only by the spring, is the beginning of the second change of character. After the spring, phase D begins, and it is composed by the true breakout, which in the case of an accumulation is called sign of strength or jump across the creek, and the confirmation event, which in this context is called last point of support. This confirmation event can also be called back up to the edge of the creek. This is the final nail in the coffin of the second change of character. Now the market is indeed trending upwards. Phase E is marked by successive signs of strength and last points of support, and the harmonic relationship between volume and price or effort and result. This generates the characteristic higher highs and higher lows of an uptrend. This is the complete horizontal accumulation structure according to the Wyckoff methodology. In the distribution structure, instead of the creek, we have the ice, which is the price level formed by the low of the automatic reaction. The other thing to pay attention is the presence of changes of character, meaning moments where the market transitions from trending to ranging or vice versa. The first change of character occurs in phase A, when the market goes from an uptrend to a sideways market, and the second change of character occurs in phases C and D, when the market goes from a sideways move into a downtrend. Let's quickly review the events and phases of the distribution. Phase A will be composed by the preliminary supply, the first attempt of the smart money to absorb demand, the buying climax, which is the climatic buying volume that ends the uptrend, the automatic reaction, which is a downward price movement that is qualitatively different than the previous counter trend moves and shows a new interest to the opposite direction of the current trend, and the secondary test, which will test the degree of demand at the same price level of the buying climax. The secondary test closes phase A and opens phase B. Recall that phase A establishes the first change of character. Phase B is the construction of the cause, the sideways movement that precedes the new trend or the effect, as the Wyckoff method determines. In the case of a distribution, we have the upthrust, which is the test of the upper limit of the range established by the peak of the buying climax, and the minor sign of weakness, which is the test of the lower limit of the range established by the trough of the automatic reaction. In the case of a distribution, phase C will begin with the upthrust after distribution. This is the false bullish breakout or bull trap that violates the highs produced in phase A and B. After the upthrust after distribution, phase D begins, and it is composed by the true breakout, which in the case of a distribution is called sign of weakness or fall through the ice, and the confirmation event, which in this context is called last point of supply. This is the final nail in the coffin of the second change of character. Now the market is indeed trending downwards. Phase E is marked by successive signs of weakness and last points of supply, and the harmonic relationship between price and volume or effort and result. This generates the characteristic lower highs and lower lows of a downtrend. This is the complete horizontal distribution structure according to the Wyckoff methodology. Until now, we dealt with accumulation and distribution structures as if they always developed in a perfect horizontal motion, but in the real market, that's not always the case. This leads us to the idea of sloping structures. There are two rules to keep in mind. First is that sloping structures follow the exact same logical events and phases of horizontal structures. Second, an upward sloping structure generally means that buyers have more strength than sellers, and downward sloping structures generally mean that sellers have more power than buyers. That means there are four possible types of sloping structures: the upsloping accumulation, the downsloping accumulation, the upsloping distribution, and the downsloping distribution. The events in phase A are critical for the determination of horizontal or sloping structures. Paying attention to phase A also allows the trader using the Wyckoff method to know where to ground channel lines, which is often a challenge to most traders who have too many options in that regard. Let's begin by analyzing the upsloping accumulation structure first. An accumulation is a structure that precedes an uptrend. The fact that it is upsloping denotes power from buyers. In other words, an upsloping accumulation is stronger than a horizontal accumulation. There is one critical detail that must be taken into account when dealing with an upsloping accumulation. Since the construction of the cause will be tilted upwards, the spring event will not necessarily break all the previous lows from phases A and B. It will probably break some of the previous lows, but not all of them, unless we are talking about a terminal shakeout event, which is a deeper spring. The key point to remember here is to look for the breakout of some lows, but also to look for the breakout of the lower channel line. That will provide another perspective about the spring. Remember that an upsloping accumulation implies an already existing advantage to buyers, so the spring event will probably not be so dramatic. In the case of a downsloping accumulation, we also have a peculiar situation. A downsloping market implies weakness, and it will inevitably create lower highs and lower lows. That means it can be difficult to spot the spring event, since the previous lows will be broken already. The key point here is that the spring event will have to be dramatic in order to create liquidity to the upside. Once again, it's important to keep an eye on the boundaries of the channel because that will help gauge whether or not we are dealing with a simple secondary test or with the spring event. The mirror image of these last two situations is what occurs in sloping distribution structures. Let's begin with the downsloping distribution. In this case, we'll be looking for the upthrust after distribution event to break some of the previous highs, but since the construction of the cause is downsloping, the upthrust after distribution will probably not break all the previous highs, especially because there is already an advantage to sellers. The key is to look for some highs to be broken and then pay attention to the upper boundary of the channel to gauge whether or not we are dealing with an upthrust after distribution or simply an upthrust. In the case of an upsloping distribution, the construction of the cause will naturally produce higher highs. And that means it will be difficult to detect the upthrust after distribution event if the trader doesn't pay attention to the boundaries of the channel, and of course, the relationship between effort and results, which is the main thing in the Wyckoff method. In this case, the upthrust after distribution event will be characterized as an overextension in relation to the upper boundary of the channel. The goal of this video is that you become familiar with all the labels and meaning of market phases in both accumulation and distribution structures. It's important that you know what each of these events and phases represent without thinking too much about them. In other words, they should become second nature to you. If this video was helpful to you somehow, please click the like button, subscribe to the channel, activate the notifications button, share the video with your trading community, and leave your feedback below in the comment section. In part 4 of the course, we'll begin to look at more refined aspects of the Wyckoff method. Thank you very much for watching, and I hope to see you in the next video. Take care.